Hi, my name's Nick Griffin from Munro Partners, and I'm here to talk to you about the investment process that we've built here over the last 13 years that we've been working in international equity markets. The key and most important thing about our investment process is that we are growth investors. Our job is to find growth companies that can grow or shrink at a more sustainable basis than the peer group. We do this most importantly by focusing on earnings. And so our investment philosophy has three overriding principles. One is that earnings growth drives stock prices. We generally find that any company that can make more money every year, we generally find its share price goes up. Two, we think that sustained earnings growth is actually worth more than cyclical earnings growth. And lastly, and most importantly, we find that the market often misprices growth and its sustainability. What I'm showing you here on these two charts is on the right-hand side, I'm showing you the share price of Bank of America over the last 10 years. The black line is the share price and the blue line is the 12-month forward rolling earnings expectations for the company. And on the left-hand side, I'm showing exactly the same thing for MasterCard. And the first thing you'll notice is their share prices are effectively following their forward EPS expectations. The second thing we'd say is that we probably don't have a lot of value to add on where the earnings of Bank of America are going. It relies a lot on macro indicators, interest rates, regulation, etc. But on the left-hand side, MasterCard, you can see, is benefiting from a simple shift from physical to digital cash. This is a structural shift, creating sustained earnings growth over a long period of time. What's interesting about this slide is I think most people know this. In fact, most people have known this for quite some time, yet the market is incapable of pricing it in. And the reason why it can price it in is because it's accelerating. And so that's our final point. The market always misprices growth and its sustainability. And the reason why that happens is because most of the market believes in mean reversion. And our job at Munro Partners is to find the situations where mean reversion doesn't exist. So how we do that and how we've done that over the last 13 years is to focus us on our core secular universe of global growth stocks. And so what we're showing you on this chart is that many years ago, we worked out in the big bubble, there was 24,000 companies in the world with a market cap above $100 million. Within that 24,000 companies is a whole bunch of companies that profess to grow. And they're always growing usually because of macroeconomic events, be it GDP will be better, or this commodity price will be better, or interest rates will be higher. And all of these things, while potentially could occur, are notoriously hard to predict. But on top of that, we'd found we didn't have an edge in predicting those things. We have a view, it's just our view's as good as someone else's. And so what we wanted to do was focus on where we could find an edge. And so what we spent the last 13 years building is this smaller secular growing equity universe. We have it down to under 1,000 stocks, and they generally come across these different areas of interest that I'm showing you on the right. And I think a lot of these are fairly obvious also. So if you look at e-commerce, for instance, e-commerce is only 10% of all commerce today. It's clearly continuing to grow share, hence it's growing at roughly 13% per annum. 10% share of all commerce will probably grow to 30% over time. And so this is an obvious place to look for structural earnings winners. We also obviously see the same thing happening with the internet, where disruption has been occurring over the last 20 years, creating large structural winners, but also in now new areas like healthcare or potentially the food and beverage revolution. The second part of our process is the qualitative and quantitative tests that we put all of our companies through. And so to find these 960 companies, we've generally either met them or met their competitors over the last 13 years of running money. We're doing over 300 company meetings a year, and every company meeting we go to, we're essentially trying to tick off these 5 qualitative traits. If you have these 5 qualitative traits, you're generally going to be a great growth company. And the first and most important one is growth. So is your whole market growing? As I said earlier, e-commerce is growing at 13%, so any company in that industry is growing, and usually in line above or slightly below that number. That's a tick. Investment banking, on the other hand, is shrinking. And while there might be some great investment banks to invest in the world, we put that down as a cross, and we're more than happy to leave that to other investors in the marketplace. The second and most important test is, can you leverage that growth? Well, some e-commerce companies can, and some can't. Generally, we then will look at the market position of the companies we're looking at. Thirdly, is the growth sustainable? Well, in e-commerce's case, we think that is the case because we see at least another 5 to 10 years of e-commerce taking share from regular commerce ahead of it. And last two are most important ones. 4, do you have a large controlling shareholder or highly aligned management? And 5, what's the customer perception of your business? We find time and time again these leaders to these very few winners. Often we have situations where you find large structural growth trends, you find a lot of potential investments, but it's always the one with the highly aligned management and the greatest customer perceptions that end up winning. The best example we always used here is the smartphone market, where at the start of smartphones in 2008, there were potentially 10 investments we could have invested in. Yet 8 of those investments didn't make it, be it Nokia, Ericsson, BlackBerry, Motorola, etc. 2 did, Apple and Samsung. And both of them had that important controlling shareholder who was militant about the customer perception of the product, positioned it for growth, sustainability, and in Apple's case, turned it into the largest company in the world. You can see similar traits at Google, Facebook, and Amazon, but also even among smaller companies that I'm sure many of you invest in today. We see it in most of the countries we look for. But these are the key qualitative characteristics we look for to get into our universe of 963 stocks. What we then do is we build on the right here, we're showing you these areas of interest. So this is just a better example going into more detail of an area of interest. This is internet disruption. We have a basket of potential winners here. These are just a cross-section of some of the companies that sit inside our universe. And it's important to remember there are sub-trends that could potentially appear here. And these are the companies that we want to do work on. The next part of our process is step 3, is the quantitative part of the process, so the idea evaluation. So out of that basket of potential winners, we will generally select a few to build our own research packs on, so we'll build an earnings model. Our earnings model generally significantly differ from consensus because we expect earnings to accelerate, not mean revert. Or on the reverse side, we expect them to decline precipitously, not mean revert. We will then also set a multiple target based on our qualitative score, and then ultimately identify a catalyst that will help achieve our price target. For our long investments, we're looking for the companies to double within 3 to 5 years. We're quite simply just not interested in finding a 3 or a 6-month opportunity. We're looking for long-term structural winners. That means a minimum of 15% per annum return every year, and we need to build that mathematically from our research packs, i.e. earnings will equal this, the multiple equal this, the share price target will be that. For our short investments, we look for them to fall 10 to 20% within 6 months. Clearly, many short investments can go to 0. In practice, that doesn't happen in a very smooth line, and so our short investments actually focus on a much shorter term time frame. The last part of our investment process is the portfolio construction, and this is where the risk controls come into play. Exposure management is driven by a bottom-up idea generation, and we often run exchange-traded put option protection over the portfolio. But ultimately, we're ending up with 30 to 50 high-conviction positions, generally across 5 to 6 different areas of interest. The average investment size for us is roughly 3% on the long side and 1.5% on the short side. And we generally try hard not to have any one investment that could undermine the returns of the fund in any one year. So we generally don't see us with positions much above 5%. Shorts are independent stock alpha shorts. So importantly, we're not trying to pair trade here. We don't have to hold shorts. I think a key important to remember about a short investment is you can only make 100% out of a short. It has clearly not got the same payoff opportunity as a long investment. They can go up 1,000, and so they make up a part of what we do, but it's definitely not all of what we do. The last 3 here are the most important, which is how we generate our absolute returns or how we manage risk to make sure on the downside. The first and most important is liquidity. 80% of the fund has to be able to be sold within 10 days at 30% of average daily volume. You can't be absolute return and not liquid, and so we commit to that. Under our measures, from what we've run for the last 13 years, we think the maximum size of our fund could probably be roughly $4 to $5 billion. The next most important risk management tool we use is stop losses. We found these have worked well for us over a long period of time, and they're a very important part of our investment process. And we have them both at the stock level and at the fund level. At the stock level, the stop losses work like this. If any stock we own falls 20% from peak or from cost, so not only from cost but also rolling forward, it's subject to a review. We sit around a table on a Monday morning, and if it's my position or Jeremy's position or James's position, they have to defend it to the entire group. If any one partner or any one part of the investment team, and this includes the CEO, decides that we should sell the stock, then it's no longer up to the manager whether he can keep it or not, because it is effectively triggered. But however, what generally can often happen is we will unanimously agree to keep that company. But if we do keep it, we can only keep it for 30 days. And then if it's still triggering, then we have to review it again. If another 30 days, we review it again. And then eventually you'll probably find out that you bought BlackBerry instead of Apple. and you'll cut that position. It will hopefully move you back towards Apple. It will move you back to that key structural winner. And what this creates is the picture we're trying to create on the right. And what we're showing you here is the basis points absolute return that we've achieved from our top 10 winning positions since inception and our top 10 losing positions since inception. And the goal of our process, as I said, is to find these great structural winners and to run these structural winners for long periods of time. And you'll see we've had a number over the last 3 years at Munro Partners. But more importantly, our goal is to make sure we don't get caught in these thousands of losers that there's inevitably going to be. And what you can see here is we've never actually lost more than 100 basis points on any one stock in the 3 years we've run the Munro Partners Fund, and also in the 13 years we've been running money. The key thing to remember about equities is an equity can actually go up thousands of percent, yet it can only fall 100%. So it's asymmetrically in your favour to own equities. The problem is more fall 100 than go up 1,000, and so you need stop losses to manage this. The last and most important stop loss is the stop loss on the whole fund. So I've been doing this job for 20 years. I've seen the market fall 50% twice. Both times nobody saw it coming, and both times even when it started, most people were telling you it hadn't started. These things generally don't tell you when they're going to happen. From our point of view, if the whole fund has a 3% drawdown, we will shrink our gross exposure. If the whole fund has a 5% drawdown, we have a review and shrink our net exposure. Why do we do that? Because we're trying to protect the absolute high watermark in this fund. Lastly, and most importantly, is on currency. As an absolute return fund, we generally don't run the currency completely unhedged, only because it's a very large absolute bet that the currency will continue to fall. If the currency rises, that's quite a large absolute bet. So generally, we're moving towards 50% of the fund is hedged back to the domestic currency. And the currencies that we do run, we generally US dollars, mainly for their risk management characteristics. So to summarise, equities is a game of very few winners and lots of losers. We generally find those few winners are driven by structural growth trends, so we focus on our smaller universe of structurally growing equities. Secondly, we generally find the key winners in these structural areas have the same qualitative characteristics, and so we measure each of the potential winners by these qualitative characteristics. Thirdly, it has to add up on the maths. There are lots of good ideas in the world, lots of good stories in the world, but if it doesn't mathematically add up, you will not achieve your absolute return over that time frame. And fourthly, and most importantly, you need to put it in a constructed portfolio. We need to find a number of ideas that A, don't correlate to each other, and B, we need to size these ideas at the right size to give us the best possible chance of achieving our returns. And lastly, stop losses are vital, both to eradicate our losers, but also to work towards our winners. Together, we find this four-step process has been very successful for us over a long period of time for generating meaningful risk-adjusted returns over the cycle. Thanks very much for listening.